On Thursday morning, December 14th, for less than 24 hours, millions Counter-Strike skin market experienced something unprecedented. Of dollars simply vanished. Rare knife skins that were worth thousands dropped to hundreds. Dragon figure prices to barely 4 laws plummeted from 5. Players who had invested their runes disappear before their eyes. What life savings watch their digital fort you're about to discover isn't just another market crash story. This is the anatomy of a digital economy that went from boom to bust faster than anyone thought possible. And the ripple effects are still being felt across the entire gaming world today. My name is Alex, and I've been tracking the Counter-Strike economy for over 6 years. I've witnessed every major market shift, every bubble, every crash, but nothing prepared me for what happened that Thursday morning. I was monitoring prices when I noticed something strange. The most expensive items weren't just dropping, they were free falling at rates that defied all logic. Within minutes, my phone was buzzing with messages from traders, collectors, and investors, all asking the same question. What the hell was happening to the market they thought they understood? Here's what makes this collapse so fascinating. It wasn't triggered by a single event or announcement. Instead, it was the perfect storm of factors that had been building pressure beneath the surface for months. Factors that most people in the community either ignored or simply didn't see coming. In the next few minutes, I'm going to walk you through exactly how this digital economy imploded. We'll examine the warning signs that were hiding in plain sight. I'll show you the specific triggers that set everything in motion. And by the end, you'll understand why this wasn't just a temporary dip, but a fundamental shift that changed everything. But first, let me paint you a picture of just how massive this market had become before it all came crashing down. The Counter-Strike skin economy wasn't just big, it was astronomical. Conservative estimates put the total market value at over $2 billion. That's more than the GDP of some small countries. Professional traders were making 6-figure incomes flipping virtual weapons. Rare items were selling for more than luxury cars. Steam market data shows that on an average day, over $50 million worth of skins changed hands. The most expensive single transaction on record was a factory-new Dragon Lore that sold for over $60,000. Yes, you heard that right. $60,000 for a digital image of a sniper rifle. This wasn't just gambling or speculation anymore. It had evolved into a legitimate alternative investment market. Hedge funds were getting involved. Professional analysts were writing reports on skin price trends. YouTubers were building careers around market predictions and trading strategies. The infrastructure supporting this economy was equally impressive. Third-party trading sites processed billions in transactions annually. Skin betting platforms generated hundreds of millions in revenue. Even traditional financial institutions started paying attention when they realized the sheer volume of money flowing through these digital marketplaces. But beneath all this success, cracks were already forming in the foundation. The first warning sign appeared in late October when Valve quietly updated their terms of service. Most people skimmed over the legal jargon without realizing the implications. Buried in subsection 12 was a single paragraph that would later prove catastrophic. It granted Valve unprecedented authority over third-party trading platforms and gambling sites. At the same time, regulatory pressure was mounting from multiple governments. France had already banned skin gambling entirely. The UK was investigating whether skins constituted actual gambling under their existing laws. Even the United States Federal Trade Commission was asking uncomfortable questions about underage participation in what they viewed as unregulated financial markets. Meanwhile, the community itself was changing in ways that made the market increasingly unstable. New players entering Counter-Strike weren't buying expensive skins like previous generations. They preferred battle passes and direct purchases from Valve's store. The collector mentality that had driven prices skyward for years was slowly fading. Professional players and content creators who had once flaunted their expensive inventories were quietly liquidating their collections. Some claimed it was for tax reasons. Others cited concerns about the market's long-term viability. But the smart money was clearly moving toward the exits. Perhaps most importantly, the mathematics underlying skin rarity were becoming better understood by the community. Advanced statistical analysis revealed that many items weren't nearly as scarce as previously believed. When people realized they had been paying premium prices for items that weren't actually that rare, confidence began to erode. All of these factors created a powder keg waiting for the right spark. And that spark came from the most unexpected source imaginable. The spark came from a 16-year-old trader named Marcus Chen from Vancouver. Marcus wasn't a whale or a professional investor. He was just a high school student who had spent 3 years building a collection worth roughly $40,000. His parents had no idea their son was sitting on what amounted to a small fortune in digital assets. On December 13th, Marcus made a discovery that would send shockwaves through the entire community. While browsing through old patch notes and developer blogs, he stumbled across a leaked internal document from Valve. The document outlined a massive overhaul to the case opening systems scheduled for early 2024. The changes were devastating for skin values. Drop rates for rare items were being increased by up to 400%. Items that currently had a 1 in 10,000 chance of dropping would soon have a 1 in 2,000 chance. The entire rarity structure that had supported billions in market value was about to be demolished. Marcus posted his findings on a small Discord server with fewer than 50 members. Within hours, the information had spread to major trading communities on Reddit, Twitter, and Telegram. Screenshots of the leaked document were shared thousands of times. Trading groups that had operated in secrecy for years suddenly went public as panic spread through their ranks. But here's where things get really interesting. The document Marcus found was completely fabricated. A sophisticated fake created by an unknown group who understood exactly how to trigger a market panic. The formatting was perfect. The language matched Valve's typical communication style. Even the metadata appeared authentic when examined by digital forensics experts. By the time anyone realized the document was fraudulent, it was already too late. The psychological damage had been done. Traders who had built their entire strategies around scarcity were frantically dumping their inventories. The market makers who provided liquidity during normal times found themselves overwhelmed by sell orders they couldn't match with buyers. Steam servers began struggling under the load. Transaction processing times that normally took seconds stretched into minutes, then hours. This technical instability created even more panic as traders worried they wouldn't be able to exit their positions at any price. Major trading platforms implemented emergency circuit breakers to halt transactions temporarily. But these safety measures backfired spectacularly. Instead of calming the market, they convinced traders that the situation was even worse than they had imagined. When trading resumed, the selling pressure was even more intense. The cascade effect was brutal to witness. As prices dropped, automated trading bots triggered their stop-loss orders, creating additional selling pressure. Traders who had borrowed money to purchase expensive items faced margin calls they couldn't meet. High-profile collectors who had built their reputations around their inventories saw their social status evaporate along with their net worth. What made this collapse unique was how it exposed the market's fundamental vulnerabilities. Unlike traditional financial markets, there was no central authority to step in and stabilize prices. No government-backed insurance to protect investors. No regulatory framework to prevent manipulation or ensure fair dealing. The interconnected nature of the skin economy meant that problems in one area quickly spread everywhere else. Betting sites that relied on stable skin values found their business models destroyed overnight. Content creators who had built audiences around high-value trades suddenly had nothing valuable to showcase. Even professional esports teams saw their sponsored skin collections become worthless overnight. International traders faced additional complications as currency exchange rates fluctuated wildly. Someone who had purchased skins with euros at peak prices found themselves taking massive losses when forced to sell for US dollars at crashed values. The human cost of this collapse extended far beyond simple financial losses. Support forums filled with stories of people who had lost college funds, down payments for homes, or retirement savings. Some traders reported symptoms of depression and anxiety as they watched years of careful investing disappear in a matter of hours. Recovery efforts began almost immediately, but the damage was already done. Trust, once broken in a speculative market, proves nearly impossible to rebuild. Even when Valve officially denied any plans to change drop rates, prices remained depressed as traders remained skeptical of any official communications. So there you have it. The anatomy of a digital economy that went from $2 billion to rubble in less than 24 hours. What started as a sophisticated hoax by unknown manipulators became a real-world lesson in market psychology, crowd behavior, and the fragility of unregulated financial systems. The Counter-Strike skin market collapse wasn't just about virtual weapons losing value. It was about what happens when speculation meets manipulation in a space with no safety nets. When trust evaporates from a market built entirely on perception and scarcity, the results are as swift as they are devastating. The warning signs were all there. Regulatory pressure mounting globally. Valve's updated terms of service, changing player demographics, smart money quietly exiting positions. But in the euphoria of a bull market, these signals got drowned out by the noise of easy profits and viral success stories. Today, the market has stabilized at roughly 30% of its pre-crash values. Some traders have rebuilt their portfolios, others have left the space entirely, scarred by losses they never saw coming. The infrastructure remains, but the confidence that once drove billions in daily volume may never fully return. This collapse will be studied for years as a case study in digital asset bubbles and market manipulation. But for the thousands of people who lived through it, who watched their investments vanish in real time, it's a reminder that in unregulated markets, you're never just one fake document away from losing everything. The question now isn't whether something like this could happen again, it's when, and whether we'll be smart enough to see it coming next time.